The food and beverage space, as we know it, has been one of the most dynamic corners of M&A. But right now, it's undergoing a major reset, right? Valuations have shifted. Corporate buyers are pulling levers differently than private equity. Consumer behavior is forcing operators to kind of rethink what's really creating value, right?
Young food and beverage companies were basically just pouring money into top-line growth. And then, of course, that went off the rails during COVID. 40 years ago, they were decade cycles, right? There might be 20 years of brand loyalty. Today, they've been compressed to a couple of years. Big food, big beverage companies have woken up to the fact that there's leakage in their brand portfolios that has to be fixed.
Hello, everyone. Welcome to another episode of This is M&A. My next guest is a managing director at Carter Morse Goodrich, a boutique M&A firm that specializes in founder-led and family-owned businesses, valued between $25 million and $250 million, although they touch a little higher than that. Ross brings over 3 decades of global beverage industry experience, having worked across Europe, Latin America, and emerging markets on more than 100 plus transactions. Before joining CMG, he built a career at KPMG Corporate Finance, Capstone Partners, and as a trusted advisor to both founders and large corporates. Outside of deal making, Ross has a passion for horses. He's even competed in the Mongol Derby, the world's longest horse race, 1,000 kilometers across Mongolia on semi-wild horses over 10 days. With that, everyone meet Ross Colbert.
Hi, Steve. Thanks. Appreciate the introduction and happy to be here with you at This is M&A. Thanks for the introduction.
Definitely. I'm going to have to dive deeper into the horses. That's interesting. Tell me a bit more about, that sounds like a wild ride, right? It's already a wild horse over 10 days.
It's wild, all right. Yes. A year ago, August, I competed in the world's longest horse race, the Mongol Derby, as you mentioned. For me, it was a bucket list item that I'd been chasing for 15 years. So I was in Mongolia in 2009. My wife and I got married there. We eloped, spent a few weeks on a horse track and ended up at our wedding in the Gobi Desert. And from that moment on, I heard about the race then, 15 years ago, and it had been on my bucket list ever since. And I knew that if I didn't get it done soon, it was going to slip by me. So last year I took the plunge and had the ride of a lifetime. I grew up around horses, so I sort of knew what I was getting myself into. But honestly, when I was in the midst of it all, it was pretty overwhelming, but really inspiring at the same time.
I bet. I do cross-country dirt biking. I think you and I actually had this conversation once before. I don't think that compares to the horses, though. I mean, you're on a whole nother level. In fact, I'm going on a 120-mile ride in Reno, Nevada here pretty soon. That's a pretty long ride for us, for myself.
Yeah.
I think on average I do about 60, so it's going to be a bit challenging. Yeah.
1,000 kilometers, 620 miles. It'll definitely test you.
Oh yeah. No joke. Well, listen, I'm happy to have you today. I'm happy to pick up our conversation from previously. Today, we're going to dive into the new rules of food and beverage as it relates to beverage M&A and what today's deals are really rewarding in this modern landscape. So the food and beverage space, as we know it, has been one of the most dynamic corners of M&A. But right now, it's undergoing a major reset, right? Valuations have shifted. Corporate buyers are pulling levers differently than private equity. Consumer behavior is forcing operators to kind of rethink what's really creating value, right? So the goal for the audience on today's episode, we hope to unpack why revenue multiples are dead and why EBITDA discipline drives premium valuations in the food and beverage space. We're also going to touch on the distribution aspect of things, how it's the hidden moat that really separates winners from losers when deals start to get competitive. And then lastly, when premiumization and sustainability still commands premiums, right? Even as consumers feel the economic pressure. So with that being said, where should we get started here, Ross? I mean, we have a ton to unpack. I hope we get through it all, but
we will.
We might have you back on.
Yeah, I'd love that. But you're absolutely right, Steve. There's been a lot going on in the food and beverage industry sector. When you think back one of the in the food and beverage sector was very adversely impacted during COVID. There were certain channels and categories that exploded, other channels and categories collapsed. And as a result of that, you had massive disruption through the value chain in food and beverage. And to be honest, it's taken 3 or 4 years to get through that cycle and post-COVID phase where companies really had to dig deep to re-engineer their supply chains, to fix what was broken, but also to build in kind of future-proof their businesses if this were to happen in the future. And I think there were some kind of key takeaways that the food and beverage industry endured, and now you're seeing quite a shift in the way food and beverage executives look at their business models today. So I think first and foremost, I'd say it's always important to remember in the world we're in today, given sort of uncertainty, higher risk, geopolitical issues, and then you add on tariffs, it's really been a question of food security and security of supply. And what do I mean by that? If you think about it today, the C-suite in food and beverage has to make sure they get the right product at the right price at the right time and in the right place. And they have to do that all through the lens of sustainability, because today the consumer is paying close attention to all of that. And they want to be able to trust the brand owner, the processor, the distributor, that they're abiding by those kind of same principles.
Just to chime in on that, I've personally, in my world, where I'm at, I've seen a huge shift away from bigger brands. I've seen a shift to homegrown brands that are, in city, that are local, farm to table, right? There's been a huge shift. And actually, it was probably happening pre-pandemic. But I mean, you're closer to this than I am. Post-pandemic feels like it's really cranked up a few notches. People wanted to get out and about, they're starting to get integrated more into, right? And so you see a lot more of these microbreweries popping up, right? Things like that. Is that what you've seen as well?
Yeah, when you think about some of the big disruptions from COVID, urban population centers, people moved out of the city. They moved to somewhere that they really wanted an immersive experience beyond just the workplace. So largely, rural communities were impacted by a whole, surge in folks moving into their communities, looking to try locavore suppliers, visiting farm to table restaurants, getting a whole new appreciation for the food chain upstream, right? Closer to the farm gate, as I say. And as a result, at the same time, millennials have demonstrated they don't trust big brands. When you think about it, the big brands, food and beverage, I mean, they have a bullseye on their back, knowing that millennials and young people today, and it goes across a wide demographic, are really holding them accountable. From processing through distribution, and they'll let you know immediately, if they think you're not playing by the rules or demonstrating the right ethical values, they're going to leave you and they're going to go find a brand that they can support. So that's been a key driver in food. And it was happening before COVID, but I think COVID just elevated the whole dynamic around these. Small is sexy. Small means different. Small means premium or smaller. And as a result, you see these local, in some cases, hyper-local businesses that flourish and they do really, really well. And at the same time, I mean, you pick up the papers today, what are the first things you're reading about? Brands like Mondelez, like Heinz, like Unilever, all facing restructuring issues as a result. And the answer is quite simple. It's like, yeah, where'd all that business go that they had? It went to smaller, more ethically sustainable and focused entrepreneurs. And, this is the story of really the last decade in food and beverage, but it's certainly been the last 3 or 4 that we've seen the big changes, because big food now can no longer sort of ignore it, right? They now have to take action. You asked the question, what is M&A solving right now? What is it rewarding? And I think it's rewarding simplicity. And by that, I mean, you take, all of the complexities that we've seen through supply chain disruption and all of the steps that big food and big beverage companies have had to take to resolve those issues. At the same time, these big companies are losing market share every day to smaller local competitors that, keep just, I hate to use the pun, but nibbling away at their market share. And it's very effective. So, I think big food, big beverage companies have woken up to the fact that there's leakage in their brand portfolios that has to be fixed. And I think Wall Street investors are echoing that sentiment that, hey, you need to fix your core business. You need to stop thinking about inorganic M&A and take a look at your portfolio and rationalize non-core assets and orphan brands, or all of the big players today are going through that exercise. I mean, some had started earlier than others. Nestle's sort of in the later round of divesting of non-core assets. They did bottled water 3 years ago. They still have a ways to go in that category, but they've announced they're divesting their European water assets. Is underway right now. But you think about, Kellogg, what Kellogg's gone through in the last year, Unilever, Nestle, Keurig Dr. Pepper is now separating into two companies in 2026. And of course, Kraft Heinz has already publicly announced they're split up. And, I pick up the headlines. PepsiCo's, got an activist investor now holding them accountable to what could potentially be sort of a refranchising of their company-owned beverage assets. So
you're seeing it in the broader M&A ecosystem as a whole, not just food and beverage. I'm seeing it everywhere, right? They're saying we need to focus on our core business. Let's divest anything that's going to distract us.
Yeah, and so it's spin-offs, and I think we've seen that movie before. It does generate results, but more likely than not, when spin-off occurs, that ends up getting sold by or purchased by a third party. You think about Kraft Heinz today has 56 brands. They cover 56 categories. Excuse me, their brand portfolio. And they're going to split those up. I can imagine half of those being acquired by new either private equity or other strategic buyers.
That was where I was going to actually segue my question to you is, so who's buying these businesses, right? As they're divesting, who's buying PE versus other strategics? What does that landscape look like? And
well, I would say historically, if you look back over the last 5 years, it's and this really goes back to COVID when it really got triggered, it's been largely 75% strategic buyers. And basically, until very recently, private equity was sort of on the sidelines because they just couldn't afford to pay the kind of multiples that big strategics have historically paid. And I see that still continuing today. When I looked at 2025 numbers, I can easily see 75, 78% of M&A has been to strategic buyers and the balance to private equity. But if you look back, Steve, 3 years ago, it would have been 85%. So private equity has gotten back in the game, particularly last year, but they still have a ways to go, I believe. And that's driven, number one driver is interest rates, right? That's if we see, I think, a reduction in interest rates as we expect to between now and the end of the year, I think that'll even be an incentive for more private equity investment. I think it just stands to reason.
Makes a lot of sense. Makes a lot.
That's good. I think business owners today, not everybody wants to sell to a strategic, right? There are sort of opportunities for private equity investors. They play an important role in sort of providing the next step of liquidity rather than an outright sale. So it's good that I think it's good that private equity is playing a more active role. But at the same time, strategics are driving valuation, and that's always a challenge. Good for business owners.
Right. Well, let's talk about that. For these business owners, entrepreneurs that are considering what do they do, right? What direction do they go? Is it PE? Is it strategic? Help give some guidance there. What are the advantages of PE? What's the advantages versus strategic? What are you seeing on the multipliers? Are you getting better multipliers with strategics versus PE? What's that landscape look
Yeah,
like?
it's when you think about it, and particularly in food and beverage, I guess, Steve, even though it's what I focus on exclusively, but I know intuitively that brand multiples are always higher than sort of, B2B suppliers or industrial service companies. It's, the only thing I can think of higher than uh, some of the brand multiples you see, and I'm talking like the 15 to 20 times EBITDA, are things like AI or
It's the AI wave
it's
that we're in.
it's 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 tech, right? And it's healthcare. I mean, there certainly are some big healthcare, valuation multiples we see, but consistently in consumer, food and bev punches above its weight as a result. And it's the predictability of food and beverage that enables multiples like that to be paid because it's consistent, it's predictable, it's it lends itself well to higher valuation. Um, but not every category gets the same multiple. I mean, it really comes down to growth. The growth rate is what drives valuation multiples more than anything. Um, but when you combine sort of the some of the high valuation multiples you see in hot categories like take energy drinks or probiotics or
I've
cosmetics.
never seen so many probiotic drinks in my refrigerator. I don't do the shopping at the home, but there's all these off brands that my wife gets. She's about 10 years younger than I am, but
Yeah.
I'm starting to see a lot more of those probiotic beverages sitting in my refrigerator.
Yeah, look, everybody likes to takes a strong interest in sort of their health regimen, their daily health regimen. And increasingly, and we've learned this over the last 25 years, that you can't rely on, you know, uh, brand owners to do it for you. You have to sort of pick what's best for you, and it becomes very personal. And as a result, these become sticky brands that consumers subscribe to. And functional benefits today are important, whether it's gut health or cardio or skin. It's all a function of people wanting to live their best life, look good, feel good, and be prescriptive around what they do to get the best out of that. And I think those businesses are growing, and that's a direction consumers keep following. I think that you would have to say health and wellness is still today in food and beverage the key driver, right? And will be. It's not a trend.
No,
It's not a fad.
it's here
This
to
is a
stay.
long-term trend. Yeah.
It's here to stay. I see it all over the place. It's here to stay for sure. Just in the past couple years, for all those reasons you gave earlier, geopolitical and everything else, interest rates and all of that, private equity, money sitting on the sidelines, lots of dry powder. It's been accumulating for a while. We're hoping that starts to shift here soon now that some certainty's coming down the hopper. But how has that changed the diligence process for you and the clients you've been working with in the food and beverage industry right now?
Yeah, great question. I think first and more than anything, there's real focus on historical EBITDA, right? There was a period of time during the pre-COVID, you saw it a lot in kind of smaller entrepreneurial businesses that were yet to be cash flow positive. But they were basically, a lot of young food and beverage companies were basically just growing, pouring money into top line growth. Just grow the top line revenues at double digit rates as fast as you can, buy market share, and ultimately when the dust settles, you'll be profitable at some point, but you're going to get valued on a multiple of revenues. And then, of course, that went off the rails during COVID. And what we found is investors, strategic investors, as well as private equity and family offices, they all zeroed in on, no, that's no longer the right approach. We're basing value on EBITDA, trailing latest 12-month EBITDA. And it's like there was a complete reset in valuation metrics.
And that's across the board. I'm seeing, I mean, with the exception of AI, even in tech, in my world, I'm seeing that there's more focus on EBITDA than ever, right? It's no longer just burn at all costs and just scale. There's some consideration around EBITDA. I'm not saying it's shifted completely, but I could tell there's definitely been an emphasis on it.
Let's face it. I mean, commercial lenders who kept, feeding the fire here for entrepreneurs, just giving them more and more capital, whether it was, private equity or whether it was banks. Eventually, that had to slow down. And when it did, a lot came with it. There's been a considerable slowdown in the markets. You had downsizing across many industries and many sectors, food and beverage being an obvious one. So that pendulum has swung back to where we once were, which was, really focused on trailing 12 months EBITDA. Yes, you can run a discounted cash flow valuation model. And if you have some growth, that's going to, that's probably going to give you a very healthy value as well. But it's no longer about using revenue comps to benchmark your company's value. I guess the other thing that goes with that, and we've seen this in the last few years, certainly it was happening before COVID, but even more so since, is the need for a quality of earnings, Q of E analysis, because there were so many adjustments to the P&L coming out of COVID. I mean, we looked at pitch books where, more than half the ad backs, more than half of the EBITDA was ad backs.
Right.
And you because of COVID related disruption,
all those one-time fees that it's like, hey, that's not permanent here. Yep.
Yeah. And a lot of that got sort of ripped apart, and investors said, time out. This is, we're not going to play this game. We're going to get an outside accounting firm to come in and do a Q of E and really pressure test the assumptions that many business owners were making. Many of them for good reason, but it's just that reached a threshold where, okay, now we're gonna do this the right way. Now it's almost essential that a business owner who's contemplating a sale has a Q of E done. It's rare that we see an M&A deal that there isn't one done.
Yeah, that was exactly what I was just going to say, right? And correct me if I'm wrong, I'm part of the M&A ecosystem, but I'm not nowhere as close to it as you are. But companies at 100 million used to get a QOE. That was pretty common and above. But going down from there was a little less common. That's not the case anymore. Now you're seeing 5, 10, 15, $20 million businesses getting QOEs because they want to make sure they're not leaving money on the table, right?
That's right. Yep, absolutely right. The difference might be, at $100+ million transaction, you might be using KPMG or, one of the other big accounting firms. Whereas at the smaller, maybe a smaller size of $15 or $20 million transaction, you might be using maybe the local accounting firm or, someone that's perhaps whose cost is a little more in line with the size of the deal. But they're having them done. And they do pay off. I have to say, if somebody is challenging the benefit of having a Q of E or not, I think more often than not, that's kind of penny wise, pound foolish, because the benefits of if you can demonstrate that, one or two of these adjustments are certainly legit, so to speak, or they can be supported, then it can be hundreds of thousands, if not millions of dollars or more. So it pays for itself.
I know there's in my audience, we're gonna have a mixed bag. A lot of folks know what a QOE is. Some don't. Some have no idea what. So maybe if you can give the dummy version of what's a QOE right?
Yeah, no, it's called a quality of earnings report. It's typically done by a third party, not your accounting firm, but a third party. Typically before the as part of the SIM, as part of the writing a confidential information memorandum that contains, um, the all the balance sheet and P&L details as part of the overall pitch book, but you would have a separate Q of E done, which focuses in on just sort of the operating results, the forecast, and the adjustments to EBITDA, and provides a gap accounting uh, analysis of those charges. So it's it typically takes it could take anywhere from 4 to 6 weeks typically for an accounting firm to come in and do that kind of work. It gets a little crazy at certain times of the year, like the end of the year, because there's always like a big push to get your Q of E done because there's limited resources out there. All the accounting firms are tied up. But we advise business owners thinking about a sale or in the midst of a sale or going to market within the next few months, get a Q of E done. It will take the pressure off of you to, to have to defend these adjustments. It gives you the opportunity to make sure you got it right, make sure that an outside accounting firm has blessed them, so to speak. And, I think it allows you to kind of focus on the other important things in a transaction. So,
Perfect. Well, let's shift
yeah,
let's shift gears a little bit.
sure.
In the broader M&A ecosystem, I'm seeing a more of an emphasis on operations, and I think you alluded to in the food and beverage, it's more focus on distribution as the moat. So let's talk about distribution a bit. Why do you think so many entrepreneurs underestimate how important distribution is? It's not just the brand; the
Yeah.
distribution model is so important. Why do you think that is?
It all starts at the top, right? Generally, founders or CEOs of operating companies, you know, historically they've always been sort of very brand centric, right? They're the founder, they help build the brand, it's their baby, and they go to market with that focus and passion that I'm building my brand. And often what I see is the C suite is very focused on the brand building, the image, the advertising, the messaging, but not as focused on the route to market. And oftentimes it's, it starts local as they build out their business and their supply chain, then it starts to expand and you go from hyper local to regional, you become a regional champion, then you start kind of carving out more territory. And oftentimes it can be a function of what I call strategic drift, where you start out very hyper focused, but as the business matures and you gain confidence, you tend to take more risk on, and often that shows up in wanting to move too far too fast. And it's a classic mistake that small brand owners who have, who are, want to move quickly and strike. Maybe it's taking advantage of a first mover advantage and trying to push as quick as they can from coast to coast, and often making the wrong decision when it comes to distribution. I tell people all the time, when if you're building a distribution network, um, it's better to go slow and be methodical than it is to move too quickly, because it only takes one distribution agreement that you've entered into, when the distributor goes sour for whatever reason, right? You don't see eye to eye. In many states, given franchise laws around the country, distribution rights can be very problematic if you need to take them back. If you need to buy that guy out and take back your distribution because he's not taking care of your product, or maybe he's conflicted with other brands. Could be a whole host of reasons, but distribution is a game changer. And you can have, as if you know this as well as I do, that you can have the greatest tasting product in the best package with a fantastic brand name, but if you can't get it to the retail shelf on a consistent basis, you're going to fail. And ultimately, distributors know that intuitively. They know they're kind of a key link in the value chain, and they take advantage of it, right? They can be difficult. They want to win too. And but I have to say, what I've seen over the last few years is distribution has become much more much more visible, very important. I think entrepreneurs have learned these lessons, and they're being much more mindful and better educated about how to deal with building a distributor network.
Just putting it into context in my world, right? The tech SaaS, it's the way acquirers think of user acquisition channels, right?
Yes.
Very similar to that. So in the food and beverage world, acquirers are starting to value more the route to shelf, right?
Yeah, absolutely. And the other thing we've seen just over the last decade, but it happens more and more every day, is distributors have become very smart, right? They've realized that they're an integral part of the value chain, and now they're investing in it. Like a lot of these distributors, successful ones, have co-invested into the brands they distribute, so that brand owner and distributor are aligned, right, for success. And when some of these brands eventually get bought by big food or big beer or big beverage companies, often the distributors are getting a big payday in the millions of dollars as a result of having contributed sweat equity, but in some cases actually invested hard dollars as a shareholder. And honestly, I love that. I think that kind of alignment generally outperforms just a typical distributor relationship because of the incentives.
Yeah, there's incentives to keep it. Yeah. Yep. So just to shift gears here for a second, so we can close out on this particular topic, because I'd love to get into us talking about premiumization as well as the sustainability. What's one, I guess, founder advice that you would give that would help them avoid maybe a distribution blind spot, right? That maybe through the amount of deals you've worked on that you can kind of give to the audience.
Yeah, one thing bears mentioning, and it can be significant depending on the situation, but oftentimes today, if you change distribution systems, if you're a brand or a food or beverage brand owner, and you've built your model with a certain distributor network, and ultimately you sell your business to a strategic, you then have the challenge of having to pay off the existing distributors to move that distributor network, right? And each of those distributors has an agreement that typically has a formula with a multiple in it. It could be 2 times, 3 times gross profit for the latest 12 months. It could be based on revenue or X dollars per case. It just depends. But ultimately, there's a hidden cost to changing distribution systems, and it can be in the tens and tens of millions of dollars.
Adds up quick, right?
And it's an unseen, unforeseen. I mean, most people realize in the process that they realize, like, okay, there's a cost here that someone's going to incur.
Right.
Often the buyer, more often than not, because it's just factored in as part of a deal to change the distribution system. Right. But it's a good heads up when you're thinking about that to not overlook that.
That's a good learning for everybody. So, again, now just to kind of shift topics a bit, I know in our discussions, kind of teeing up this podcast, you and I talked about loyalty of the consumer, and that consumers will trade up. And I see it happen often, right? One thing's hot for 1 minute and the next it's gone. Let's talk about that a bit. Is that permanent, or is that just a cycle? What are your views on that?
It's stunning, really, because I go back a long, long ways. I was in the Red Army working in the Coca-Cola system when I first joined, and back in the 40 years ago, people that our generation was so brand loyal,
Oh
right?
yeah, it was Coke or
You were a,
Pepsi. You
you
pick
were a Coke
one.
guy for life. You're a Pepsi guy for life. Maybe you drank Dr. Pepper for life,
Yeah.
but you didn't migrate.
Right.
And fast forward to today, and what I see is a consumer that is constantly looking for new brands, new opportunities, new package formats that speak to them and their personal values. And it's intensified by social media and influencers who can really sort of get inside your head very easily and change those loyalties, or play on them. And it's become a huge issue. And I think what it leads to is these brands, food and beverage brands, have cycles. And the cycles, 40 years ago, they were decade cycles, right? They might be 20 years of brand loyalty. Today, they've been compressed to a couple of years, 2 or 3 years, and consumers get tired and are like, oh, time to move on. Uh, and it's good and bad, right?
Do you see that happening across other sectors as well?
I see it happening, across
Yeah.
all consumer,
Yeah. Yeah.
fashion,
Oh yeah.
music,
Yep.
uh, all food and beverage, certainly health and beauty, same thing. And I think it's driven largely by uh, social media. We have far more choices than we ever had in years past. And we're better educated, consumers are better educated across all these, you know, emerging categories, and they want to explore because it's all at their fingertips, right? You can poke around and on the internet and in a nanosecond come up with something that
Oh yeah.
you go, wow, I got to try that.
Yep.
Yeah.
Oh yeah. So now sustainability, is that a nice to have in valuations? Is that a must have? What's your views on that?
Yeah, I think I think we've reached a tipping point where it is now a must-have. I think young people today, with the ability to immediately search and recognize whether a company is ethical or not, or is it just greenwashing, or do they really walk the walk and talk the talk? And I think that that's hugely important. And responsible brand owners know that, and they turn it into a positive, right? They recognize that's the best way to build a long-term relationship with a customer. uh, and so yes, I think it's hugely important no matter where you are in the consumer landscape. uh, Food and beverage is very personal, so I think that makes it even more important to recognize.
I'd agree. I'd agree. Unfortunately, we're running up against the clock and we still have a couple other items we got to close out on. We could go into this topic, I think all three of these topics in more depth, a layer deeper, if time had permitted. But this was all great. This got us to scratch the surface of it. Now I want to get personal with you just for a split second. You know, how'd you get into this? Like, where was there some mentor that brought you in and said, "Hey," right? Or was there?
Yes.
Okay, let's talk about that. Who was your mentor?
He is a wonderful man. He was a Coca-Cola bottler in Tennessee named Summerfield Johnson. And the Johnson family was I guess, probably a fifth generation Coca-Cola bottler in Eastern Tennessee. And they ran wonderful operations through the Midwest, up from Minnesota down through the Mid-South. And I was about 24 at the time, and I was still sort of a horseman, but Summerfield took me aside one day and said, "Ross, you're a pretty good horseman, but you should probably think about a career." And I was at that age where I really didn't know what I wanted to do. And he helped me get into a management training program at Coke. And that was my sort of foundation, was working in the Coca-Cola network through the South and Southeast down in Florida largely. And that got me hooked on the beverage industry.
There you
And
go. That's an
from
interesting story.
yeah, so I spent 5 years on the operating side and went back to business school, got my MBA, and moved to New York to work for a family office advisory firm in New York. And
Well,
Loved it ever since.
well, just for a plug for you, I mean, having that operational background in the space that you're serving as part of the M&A transaction and advisory standpoint, it's huge because you can empathize with where your clients are and where they want to go and all the motions that play into all of that, right?
Yeah.
Um,
Thanks, Steve. You're
yeah,
absolutely right. I'm not sure I realized it was at the time, but as the more I was in, as I pursued investment banking for beverage companies, the more I realized like operational experience, it trumps just about anything.
I hate to say it for all those that went and got the education, it trumps even that because there's no better education than being on the front lines and being part of it. It's just a different experience,
Yeah.
right?
No, I started out on a route truck in Miami Beach, so it's
Okay.
sort of
So you're not afraid to roll up your sleeves and get it
not
done.
at all.
So question for you, and this will tie up on the personal front, but that mentor, did you get a chance to tell him thank you?
Oh my gosh, yes. I saw him this past spring in Florida, and he's just the same. He was a wonderful business mentor. I came that close to going to work for Burger King at the same time, and it was sort of go to Coke or go to Burger King, and I went for into the Coca-Cola network, and it was probably the smartest thing I ever did.
Yeah. Well, for the audience, don't forget to thank your mentors. It's extremely
Yeah,
important.
absolutely.
Yep.
I'm glad you asked. Thanks, Steve.
Definitely. I'm sure our listeners are going to enjoy this episode. We unpacked a lot here. It was a very great and thorough discussion on all of the topics. How do people get a hold of you if they want to learn more?
Oh, thank you. So yes, I'm at Carter Morse and Goodrich in Southport, Connecticut. Our website is www.cartermorse.com. And you can call, my phone number is 203-203-0057.
Perfect. Thanks again for participating on this. I look forward to having you come back and so we can dive deeper into some of these topics. But with that being said, that's a wrap on another episode of This is M&A. We look forward to seeing you on the next episode. Until then, stay sharp, stay deal ready.
Stay thirsty.
There
Thanks,
we go.
If this episode sharpened your thinking, share it, post your take, follow the show, or drop a quick review and bring it into your next deal. We'll be back with more real talk from people who've been in the room when it counted. The views and opinions expressed on This is M&A are those of the guests and hosts and do not necessarily reflect the views of any company or organization mentioned. This podcast is for informational purposes only and should not be considered legal, financial, or investment advice. Always consult a qualified professional before making business decisions.